Good morning, traders. This is Brad Matheny. Today is July 24th, early in the morning. We're going to talk today about the Fed conundrum and the global central bank conundrum and what it means to you and what you need to be prepared for. I just created a video highlighting the risks to the emerging markets and China related to the long-term effects of inflation, the Fed and central banks' attempts to stop inflation, which is to raise rates, to remove capital from the global markets, and to try to stop the runaway inflationary trends that we're seeing right now after COVID. This means that the Fed is likely to continue, the US Fed and global central banks, to push rates even higher if inflation does not stall and rotate lower. This is going to push global asset prices lower, and this is going to push a big extreme into global currencies. And this is what I want you to be aware of. The risk to global markets with regards to extended contraction and currency disruptions is one of the biggest risks to the global markets, in my opinion, that we've seen in more than 40 years. We have not seen anything like this take place since World War II, and that was the disruption of Japan, most of Asia, and a lot of Europe with regards to economic destruction. This, what's going on right now is somewhat similar to a global world war. It is more than likely going to be written in the history books as a global currency war, which is essentially what inflation is. Global inflation is a war on currency valuation and the ability to have normal functions in currency. Runaway inflation presents a deflationary trend in currencies and isolates the strongest currencies, which tend to be, we'll go over them, but it's primarily Europe, Canada, and US right now. And what we're going to see is a massive wave of disruption, in my opinion, as the Fed chases inflation, trying to raise rates and disrupt the economy. Okay, so let's take a look at this and pay attention to the comparisons here. US dollar to Japanese yen. Japanese yen is, the US dollar is skyrocketing compared to the Japanese yen, meaning the yen is collapsing. Euro to US dollar, meaning the euro value is collapsing compared to the US dollar. British pound compared to US dollar, it is collapsing down to near COVID lows. This is below COVID lows for the euro compared to the US dollar. US dollar to Canadian dollar. US dollar is strengthening against the Canadian dollar, has not yet gotten up to COVID highs yet, but it's moving back into 2019 levels, meaning that we're seeing a very broad disruption, almost 20-25% in Canadian dollar compared to the US dollar. US dollar to Swiss franc. You can see here we're way off of these lows. We're up, let's see here, 88 to 96. I would say about 20-25%. We've had some very high peaks over here, and if you take a look at where we're at here, come straight across to here, we're back in 2019 and 2018 levels, 2017 levels. Australian dollar to US dollar. Australian dollar is weakening compared to the US dollar. We see this deep COVID low. We came back up out of it. We're right now at about 2018-19 low levels. New Zealand dollar to US dollar is weakening. US dollar is strengthening. And we're close to mid-COVID collapse areas. European dollar compared to British pound. The European dollar is moderately stronger over the last few months here. You can see this little uptrend here, but we are down near COVID lows with regards to historical price reference points. British pound to Japanese yen. We can see the British pound is strengthening compared to the Japanese yen, and that's because the Japanese yen has been in the Japanese economy has been in extended money printing, which means they're going to be devaluing their currency much greater than the British pound. And of course, Bitcoin down here is collapsing down at 22,600, looks like, or 500. We're back down into these peaking areas over here. If we get below this area, we're going to be down into the 6, 7, 8,000 range fairly quickly. So be prepared. Now, what I wanted to point out is how this plays out. The Fed is going to try to raise interest rates. They're going to try to stop inflation. And with all intent, they are going to keep acting in measures to try to support the economy through their raising rates. Raising rates will push credit markets and liabilities into a mode of default or refinancing as debt becomes and bonds become due. So hypothetically, if a corporation or a government issued bonds at 2%, and they were 3-year bonds and they become due, now they've got to refinance them at say 5 to 7%, which means they essentially need to roll into more expensive debt. Same thing is going to be happening all around the world. So understand that short-term bonds, long-term bonds, corporate bonds, regional government bonds, they're all going to be forced into paying more excessive rates for debt at a weaker economy and weaker currency rate. And that is the compounding of this structure that's going to take place and produce some very real risk going forward. How does that work for the global markets? Well, long and short of it, ladies and gentlemen, we're at a very interesting peak formation in gold. You can see this is gold and silver. Silver's the gray line, gold's the gold line. The S&P is down here. This was produced back in May 2022, just a few months ago. Gold is right now bottoming at like 1694, 1697. Silver is bottoming down here at around 19. Let me look real quick. $19 roughly. I want you to pay attention to the fact that metals will very quickly become a safe haven for depreciating currency values and risks that are taking place in the market going forward. The Fed and global central banks will attempt to move us into what they call a safe or soft landing, but I believe that gold and silver are poised for a very big move. And I'm talking in excess of 300 to potentially 500% as this continues to unwind. We've never seen anything like this. Years, almost more than a decade of extended quantitative easing, as well as money being supplied into the economy to spark growth. Now we have massive growth, and the Fed and the central banks don't know how to handle it, other than execute a raising policy rates while trying to navigate a fairly safe landing. This is going to put extreme risks into liabilities, which means emerging markets, China, Asia, Eurasia, and Europe are all going to be at risk in some way, shape, or form as we see global currencies really start to become disruptive. And this is not necessarily a dot-com or a global financial crisis in the sense that we think of the 2000 peak and the 2008 peak, where we had massive liability issues with the dot-com bubble in the US bursting, which was actually in Europe as well. But then in 2008, 2009, we had excessive credit bubbles, which we kind of have right now. The scenario we have right now is we have an excessive credit bubble. We have an excess technology and FANG bubble, like a dot-com bubble, taking place all at the same time. But we also have rampant inflation, which is caused by extreme price value. The way I see it, excess money in the economy creates excess speculation, creates excess what I call stupid money, chasing things that don't make reasonable sense. For example, house prices going up like they have in China don't make any reasonable sense. Having 60 or 70 million empty apartments in China and house prices have more than tripled in the last 7 years, it doesn't make any sense. Was watching Mecum Auto Auction last night. Was watching cars sell for $400,000, $500,000, $700,000. Granted, they're cool cars. They're, once in a lifetime types of vehicles, but these are vehicles that, 10 years ago would have been selling for 60 or 70 or $100,000. The vehicles are selling right now at 500 to 700% more in value than they were, say, 4 or 5 years ago. This is what I call stupid money. And I think we're nearing a decade of stupid money excess speculation, and the unwinding of this could take more than 6 or 7 years to complete. So please pay attention to gold and silver. Gold and silver have been ignored, and really stupid money has gone into things like cars and homes and Pokemon cards and you name it, Bitcoin. It's just gotten really crazy. And I think the unwinding of this because of inflation could literally blow the bottom out of some of these speculative bubbles. So now we're going to take a look over here at the cycle phases. I highlighted this in another video I just did related to China and Asia and emerging markets, but we've lived through this cycle phase, which was nominal. This was a 2015-16 peak down to a 2016-17 bottom. Remember, this was the election just before Trump was elected. We had this bottom. We had this rally that took place in 2017, fairly strong rally. We came back over here 2020. You can see we're in the middle of a rally. You can see 2020 right here, middle of a rally phase. Fed came to the rescue after COVID, and we rallied back up here to the peak. 2021 peak is right here. We're in the midst of 2022 right now, which is where I'm showing you this now line right here. And we are very, very close to a cycle peak. In fact, I think we've already reached it. But we could see another little rally here, another little bump of excess speculation. But we are within 6 to 12 months from a major cycle peak. And if this cycle, this current kind of a purplish color, is moving faster than this previous cycle, then we could already be at a peak in the markets. We don't know yet until we see real confirmation, but we don't have confirmation yet. Okay, so now the purpose of this is to show you this trigger in gold. Gold has set up a very solid basing pattern off of historical lows. You can see here, try to get the chart to show you what's going on. We don't see these historical basing patterns all that often. You can see a couple of little yellow ones right over here. This was in 2016. You can see we got some extended low, these little yellow triangles. They are telling us that the gold has reached an extreme low, and we're likely to see some sort of rotation back to the upside out of this. If we start to see yellow triangles up here, we're seeing that gold has reached potentially an extreme high. When we don't see any of these yellow triangles, which you can see, we saw some right over here a little bit. We saw none through this area, and we now have this low level here. This is warning that gold has reached an extreme low, a potential extreme low. And I believe we're going to see a very strong rally out of this as we move further into the end of the year with inflation, the Fed raising rates, and the disruption that I explained to you with the economy. Now we're going to move back to here, and we are going to highlight the gold to silver ratio. And what I want you to pay attention here, it's about it going back to 88. What I want you to pay attention to is this monthly cycle going back to 80s and 90s. So here we have 90s peaking gold value. So this is when gold to silver ratio is extremely high. Okay, this is when we get extreme low gold to silver ratio. In fact, let me add gold in here. And I will put it on a new pane. And you can see here, we have gold to silver ratio was very low. And you can see during the peak here, we have these troughs. So what we're looking for is a trough in value in the gold to silver ratio. We're looking for gold to continue to move higher, silver to appreciate dramatically, and for this to roll back over to the downside. Historically, this red area has been fairly moderate extremes, where we see, for example, here we saw it reach up to this extreme level and then roll back over into this downward area, and gold started to take off. Here we had it roll up into this red area, up into this yellow area, roll downward during the 2008-2009 crisis, and this prompted a more than 400% rally in gold, this downward cycle. Here we are back up into this red area again after COVID. I believe we're at a very critical juncture in gold. I think we're going to get a rollover in this over the next 60, 90, maybe 120 days, and gold is going to continue to take off, which means gold will likely move up above the $4,500 to $5,500 an ounce area, possibly above the $7,500 an ounce area, and continue skyrocketing if what I believe happens, which is a massive disruption to global central banks and what's actually taking place. What that means is that currencies are going to be the next crisis. Currencies and debt. I believe that's what's really going to happen here is the U.S. Fed's going to raise rates, trying to strengthen the U.S., essentially not trying to, but doing this, strengthening the U.S. dollar, and that's going to put massive disruption into global currencies, meaning that weaker global currencies are going to end up potentially worthless or falling dramatically. And because of the world trying to stave off these inflationary trends, if we get massive currency disruptions in emerging markets like China, Singapore, Malaysia, Thailand, Japan, Eurasia, parts of Europe, we could see a massive disruption, almost like World War III, except this time it's going to be the currency World War III taking place. And that's where I really believe gold and silver are going to start to shine. And that's coming, ladies and gentlemen. I don't see any way around it right now. The global markets have been gorging themselves on cheap, easy money. We now have an inflationary trend which is out of control. The only way to stop it is to raise rates, try to use normal policy to disrupt this cycle phase, and I believe it's going to disrupt global currencies much more than people expect. So now, lastly, I want to show you this. This is the European, this is Asian market, JPY and Euro to gold. You can see we've had this massive decline. It's kind of hard to see, but gold has really started to rally through this phase. This is gold. You can see the appreciation here while gold declined, and then we have this destruction phase here, another destruction phase here. We're down here, and we're really likely to see a big destruction phase over the next couple of weeks and months. And what I think is going to happen is we are going to see a roll downward. So we're at minus 39% here. Let me change this to regular mode. Change this to regular mode. We could see this really decline back down into these levels, which would be another, looks like 20 to 40% decline in global currencies. And that means that we have a scenario here, which is custom indexes here, European, Japanese, again, the same one, compared to a euro and foreign currency, which is in blue. And you can see this is in relative terms to gold. And what you're seeing here, ladies and gentlemen, from 2006, 7, 8, 9, 10, all the way through, you're seeing a period of stability here with gold holding up in the 1300 range. 1,000, 1100, 1200 range. And you're seeing currency stabilization right over here. And then you're seeing devalued currencies. Now, it wasn't excessive and doesn't appear to become excessive right away. But ladies and gentlemen, I need you to pay attention. This selling in gold that's taken place over the past couple of months from April until now, it's causing the currencies to in relative terms to gold, to look like they're performing fairly well. But understand that when gold takes off, currencies are going to devalue. And remember, we come back over here and we start taking a look at these currencies again. What would happen if the euro collapsed against the US dollar, or the British pound collapsed against the US dollar, or the Japanese yen collapsed against the US dollar? I mean, I'm talking 20, 30, 40% collapse beyond where they're at right now. What happens if the Canadian dollar collapses from where it is right now at 1.2, let me see here, 1.29, and rolls to hypothetically 1.4 COVID levels, or 1.5 beyond COVID levels. That puts us back here 2002, 2003. That would be a massive 30-40% contraction or decline in Canadian dollar. And this is where I need you to be aware. This is what's likely to happen given what the Fed is trying to do. And this is why I believe traders need to be very aware of the risks involved with what the global central banks are attempting to do. They will continue to support the economies, but I believe what's going to happen next is a massive currency disruption, which is going to leave some countries very fragile, extremely fragile, and breaking down, breaking asset values, home values, GDP values, consumer engagement activity. I believe it's going to get really fragile over the next 12 to 24 months. All right, so there you go. Gold and silver are extreme values right now, in my opinion, for protection against these currency disruptions. And I just want to warn you that I don't believe there's any way the Fed can battle inflation without creating massive currency disruptions, which means gold and silver are inevitably going to attempt to push higher. It's just a matter of time at this point. All right, follow me on Twitter, follow me on YouTube, visit ment.com, ment.com to learn more. I've got lots of great things coming. Going to be changing my website and trying to make some improvements to what I'm delivering for you. Remember, the next 7 to 10 years are all about opportunity. And this is it, ladies and gentlemen. It's coming. If you stay prepared, you will be able to profit and come out of this looking great. Otherwise, it's going to hit you sideways and you're not going to know what hit you. All right, that's it for now.